Hi, this is Nicholas Vardy, editor of the Oxford Swing Trader and contributor to libertythroughwealth.com. This week, I want to speak to you about how to profit from a bursting bubble. Now, I've recently written a lot about financial bubbles and how we may be in one. And several readers have contacted me in the past few days with the same question. Nicholas, if indeed we are in a financial bubble, how can I profit from it? That's the question I'm going to answer in this video. Let's start with the current state of the markets. Tech stocks sold off sharply in September, their worst pullback since the market bottomed in March. On the one hand, tech stocks may already be overcoming their jitters. After all, seasonality is in their favor. The period between November and May is the strongest time of the year for the U.S. stock market. On the other hand, the sell-off in technology stocks may be the start of a sustained market move down. Even if this pullback isn't sustained, it does highlight your need for a strategy for when the market bubble does pop. Luckily, today there are more ways than ever to profit from market downturn. Let me explain. It's one thing to identify a bubble, it's another thing to profit from it. If you buy into a bubble, you risk buying at or near the top. If you sell short or bet on the price falling, you risk that the stock will keep going up. You can be wrong on both sides of the trade. And you wouldn't be alone. Many brilliant people in history have gotten burned by bubbles. Sir Isaac Newton, the father of mechanical physics and calculus, lost a fortune betting on the South Sea bubble. As Newton put it, I could calculate the motions of the heavenly bodies, but not the madness of the people. In the past, I made money betting against stocks. Today, with the help of sophisticated software, I can track hundreds of exchange-traded funds trading on U.S. stock markets. These ETFs track hundreds of different strategies for different types of markets. That makes today a special time in financial history. As recently as the global financial crisis of 2008, most investors were powerless in the face of a sharp market sell-off. Betting against the market by selling a stock short required special permission from your broker. Shorting was also expensive, and trading futures was even further out of reach. Now that's all changed with the advent of specialized exchange-traded funds. Today, inverse ETFs allow you to bet against the market as easily as buying or selling a stock. Say you're convinced that tech shares are set to crash and you want to profit from that sharp downward move. You can bet against the NASDAQ 100 by buying the ProShares Short QQQ ETF, ticker symbol PSQ. If the index drops 10% today, this ETF will rise by the same percentage. There are even leveraged versions of this short bet. You can invest in the ProShares Ultra Short QQQ ETF, ticker symbol QID, and when the NASDAQ drops 10%, the fund will jump around 20%. Finally, the ProShares Ultra Pro Short QQQ ETF, NASDAQ symbol SQQQ, offers triple short exposure to the market. A 10% drop in the NASDAQ 100 could generate you up to a 30% return. Invest in inverse ETFs at the right time and you can make more money more quickly once that bear does jump out the window. That said, understand the pricing of leverage ETFs is reset daily. That means they are for short-term speculators only. The bottom line, once you identify a financial bubble, there's probably an ETF that will allow you to profit from it bursting. But caveat investor, you are wading into treacherous waters. Betting against a bubble takes nerves of steel and a cast iron stomach. As the great British economist and failed speculator John Maynard Keynes observed, the market can remain irrational longer than you can stay solvent.